Don't you know you drive? Don't you know you drive me crazy? Don't you know you drive? Don't you know you drive me crazy? Don't you know you drive? Don't you know you drive me crazy? Don't you know you drive? Don't you know you drive me crazy? So 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 don't you know you drive me crazy? Don't you know you drive? Don't you know you drive me crazy? Don't you know you drive? Don't you know you drive me crazy? Don't you know you drive? Don't you know you drive me crazy? Don't you know you drive? Don't you know you drive me crazy? You can have anything. You can have anything. You can have anything. Took my heart and plus a ring. Think about you all the time. Think about you all the time. Think about you all the time. What kiss to blow my mind.
All companies engage in three types. And this is known as debt financing. Once we have cash from the financing activities, we can invest in ourselves by buying long-term assets, specifically land, buildings, or equipment. Once we own land, buildings, or equipment, we're ready to operate. Operating activities are selling products or services like tacos from a food truck and all the necessary expenses related to sales. So let's assume we are operating a food truck and we raise money by selling stock or taking out a loan, a financing activity. We bought equipment like the food truck and equipment for the food truck. Those are investing activities. And now we're ready to operate. Sell tacos. Assume we have the world's greatest taco and we are making lots and lots of money in our business. What should we do with all that cash from operations? Well, we could buy more food trucks and expand. We could pay back our loan. If taking out a loan is a financing activity, so is paying back the loan. We could also pay back our owners by giving them a dividend. If selling stock is a financing activity, so is paying them back, so a dividend is a financing activity. Now assume we accidentally poison customers and we get sued. Now we need cash for a lawyer. How do we get more cash? Well, we probably can't sell any more stock as no one would want to invest in us. Banks are probably not going to give us a loan, so we're not going to sell any more tacos, so no cash from operations. So our only option is to sell our long-term assets, land, building, and equipment. This would be a cash inflow from investing activities. So to recap, financing activities are selling stock or getting a loan, paying back the loan, or paying dividends. Investing activities are buying and selling long-term assets, specifically land, building, and equipment. And operating activities are sales and expenses. All these activities go into an accounting system, a system of financial recording. The accounting system then produces accounting reports, both financial and managerial. Managerial reports are used by the internal users of the company, like managers and supervisors, and they are used to run the company. They include things like determining whether to build, buy, or rent a building, whether to continue or discontinue making particular products, or how much to pay employees and how much to borrow. Managerial reports is what you study in 202, managerial accounting. Financial reports are used by external users like investors, creditors, governmental agencies, and financial reports are used to evaluate the company. Should I loan the company money? Should I invest in the company? Financial reports are what we study in 201, financial accounting. The bottom of the PowerPoint, you'll see that accounting is defined as a system of analyzing, recording, summarizing, reporting the results of a business activities. So all the operating, investing, and financing activities like selling stock or getting a loan are analyzed, recorded, and used in journal entries, something we talk about in Chapter 2, are then going to be summarized on a trial balance sheet and then reported on one of 4 financial statements. All companies engage in 3 types of activities: operating, investing, and financing. So before a company can operate or sell tacos from a taco food truck, they need to purchase the food truck. Before they can purchase equipment, the food truck, they need money or they need finance to finance their long-term assets. So let's start on the bottom with that financing activities and talk about 2 ways a company can raise money or finance their operations. They can sell stock to stockholders or the owners of the business in exchange for cash. This is known as equity financing. Or they can get a loan, a note payable, and this is known as debt financing. Once we have cash from the financing activities, we can invest in ourselves by buying long-term assets, specifically land, buildings, or equipment. Once we own land, buildings, or equipment, we're ready to operate. Operating activities are selling products or services like tacos from a food truck and all the necessary expenses related to sales. So let's assume we are operating a food truck and we raise money by selling stock or taking out a loan, a financing activity. We bought equipment like the food truck and equipment for the food truck. Those are investing activities. And now we're ready to operate. Sell tacos. Assume we have the world's greatest taco and we are making lots and lots of money in our business. What should we do with all that cash from operations? Well, we could buy more food trucks and expand. We could pay back our loan. If taking out a loan is a financing activity, so is paying back the loan. We could also pay back our owners by giving them a dividend. If selling stock is a financing activity, so is paying them back, so a dividend is a financing activity. Now assume we accidentally poison customers and we get sued. Now we need cash for a lawyer. How do we get more cash? Well, we probably can't sell any more stock as no one would want to invest in us. Banks are probably not going to give us a loan, so we're not going to sell any more tacos, so no cash from operations. So our only option is to sell our long-term assets, land, building, and equipment. This would be a cash inflow from investing activities. So to recap, financing activities are selling stock or getting a loan, paying back the loan, or paying dividends. Investing activities are buying and selling long-term assets, specifically land, building, and equipment. And operating activities are sales and expenses. All these activities go into an accounting system, a system of financial recording. The accounting system then produces accounting reports, both financial and managerial. Managerial reports are used by the internal users of the company, like managers and supervisors, and they are used to run the company. They include things like determining whether to build, buy, or rent a building, whether to continue or discontinue making particular products, or how much to pay employees and how much to borrow. Managerial reports is what you study in 202, managerial accounting. Financial reports are used by external users like investors, creditors, governmental agencies, and financial reports are used to evaluate the company. Should I loan the company money? Should I invest in the company? Financial reports are what we study in 201, financial accounting. The bottom of the PowerPoint, you'll see that accounting is defined as a system of analyzing, recording, summarizing, reporting the results of a business activities. So all the operating, investing, and financing activities like selling stock or getting a loan are analyzed, recorded, and used in journal entries, something we talk about in Chapter 2, are then going to be summarized on a trial balance sheet and then reported on one of 4 financial statements. Hi, this is Tammy Perry. We're in Accounting 201, and this is Learning Objective 1.2, and we're learning about the purpose, structure, and content of the 4 basic financial statements. Now, before we talk about the 4 financial statements, let's start off with a simple formula. It's the first formula that you need to know. As you will not be able to have a formula sheet on the exam, it's the basic accounting equation. The basic accounting equation is going to be assets are equal to liabilities plus stockholders' equity. The simple definition of assets is they are resources owned by the company. We will talk accounting equation is going to be assets are equal to liabilities plus stockholders' equity. The simple definition of assets is they are resources owned by the company. We will talk about assets in more detail in just a minute. The simple definition of liabilities are resources owed to the creditors, and those owed to the shareholders are stockholders' equity. So imagine you own a car worth $50,000. If you sold it and paid your debts of $30,000, you'd have $20,000 left over for the owners. Remember that what we report for the company does not include the personal transaction of the owners. For example, if I own stock for Caesars, they do not call me up every year and ask me how much cash or how much debt I have so they can add it to the financial records of the company. It's just the company's assets and liabilities. The more official definition of an asset, instead of things we own, is conceptually an asset is defined as a company's present right to an economic benefit. Practically speaking, assets are a company's economic resources. Assets include things like cash, supplies, equipment, building, and software. These are things that we haven't used up and still have value to us. The more official definition of a liability, instead of things that we owe, is conceptually a liability is a company's present obligation to transfer an economic benefit. Practically speaking, liabilities include amounts the company expects to give up in the future to settle what it owes to creditors. If a company borrows from a bank, it would owe a liability called notes payable because banks require borrowers to sign a legal document called a note that describes the company's promise to repay the bank. If a company receives paper and pens bought on credit from suppliers, it would owe a liability called accounts payable. This particular name is used because purchases made using credit are said to be on account. A company could also owe salaries and wages to employees, salary and wages payable, taxes to governments, taxes payable. Notice at this point all liabilities end in the word payable, and there are three main differences between an account and a note. An account is less formal, does not have interest, and is shorter than a note. A note is going to be more formal. Think about like a written promise to pay, has interest, and is usually going to be longer than an account. The shortest would maybe be 90 days, maybe up to 30 years like a mortgage. An account is normally like 30 days, maybe 60 days. When I think of a note, I think of a bank loan. When I think of an account, I think of a supplier. Stockholders' equity is simply the excess of assets over liabilities. It represents the owner's claims on assets of the business after creditors' claims have been fulfilled. Stockholders' equity is made up of two accounts: common stock, when we sell stock to the owners in exchange for cash, and retained earnings. That's the portion of net income we retain or keep. The amount that we don't keep is given to stockholders and is called a dividend. Dividends are not required, and some companies do not give dividends, and some companies give them every quarter. Revenues, expenses, and net income. Conceptually, revenues are defined as inflows or enhancements of a company's assets or settlements of its liabilities. In practice, revenues are earned by selling goods or services to customers. They're measured at the amount the business charges to the customer. We have two revenues: sales revenue and service revenue. Notice that both end in the word revenue. Conceptually, expenses are defined as outflows or using up a company's assets or incurrence of its liabilities. Practically speaking, expenses are the necessary costs of doing business to earn revenues. They include wages to employees, salary and wage expense, advertising, advertising expense, insurance, insurance expense, rent, rent expense, utilities, utilities expense, office supplies used up, supplies expense. Remember, under assets, we listed supplies. Now we're saying supplies is an expense. So what's the difference between supplies, the asset, and supplies, the expense? Supplies is an asset because we haven't used it up yet. We could still return it. When we use it up, it becomes an expense. Now notice all those expenses ended in the word expense. In the last video, we learned our first formula, the basic accounting equation, which was assets are equal to liabilities plus stockholders' equity. Now the next formula we're going to learn is net income. That's revenue minus expenses equals net income. Revenue and expenses are types of accounts, just like assets, liabilities, and stockholders' equity. Net income is not an account, it's just the total of revenues over expenses. If revenues are less than expenses, the business would have what's called a net loss. Our final topic, dividends. A company's profits are accumulated in retained earnings until a decision is made to distribute them to stockholders. Distribution to stockholders are called dividends. Dividends are not required, and a company can retain their earnings instead and reinvest them into the company. This is common in new companies. They may wait to give their dividends to their owners. However, there are some companies that always give their dividends every quarter. Dividends are not an expense. Remember, expenses are a necessary cost of doing business, and a business can exist and never give a dividend. A dividend is an optional distribution of earnings to stockholders approved by the company's board of directors. There are 4 financial statements, and they're prepared in a specific order. The income statement, the statement of retained earnings, the balance sheet, and finally the statement of cash flows. The income statement has revenue, expenses, and net income. Remember, the first formula we learned was revenue minus expenses equals net income, or actually that was the second formula we learned. The purpose of the income statement is to report the amount of revenues less expenses for a period of time. For Noodle Cake, revenues are earned from selling games to customers. Expenses are the costs incurred during the period to learn the balance sheet, and finally the statement of cash flows. The income statement has revenue, expenses, and net income. Remember, the first formula we learned was revenue minus expenses equals net income, or actually that was the second formula we learned. The purpose of the income statement is to report the amount of revenues less expenses for a period of time. For Noodle Cake, revenues are earned from selling games to customers. Expenses are the costs incurred during the period to earn the revenue. The income statement is prepared first in order for us to calculate the amount of net income. Notice the statement begins with the name of the company, Noodle Cake Studios, followed by the name of the statement, then either a time period, month ended, quarter ended, or year ended, or a point in time such as a specific date, December 31st or September 5th. Then revenues go first, biggest to smallest, followed by expenses. They go biggest to smallest except for income tax, which is always last. Then net income is revenue minus expenses. The unit of measure assumption states that the financial results of a company's worldwide business activities should be measured and reported using a single monetary unit, such as the United States dollar. The second financial statement we prepare is the statement of retained earnings. This statement has 4 lines. It starts with beginning retained earnings. In a brand new company, the beginning retained earnings would be 0. Then we add net income. Where would we get the net income? The income statement. That's why we do the income statement first, because we need the net income from the income statement to put in the statement of retained earnings. Next, we subtract dividends. Dividends go on the statement of retained earnings. Remember, dividends are not an expense, so they don't go on the income statement. They're a distribution of earnings, so they go on this statement. Finally, we have ending retained earnings. It is the ending retained earnings, the $1,000, not the beginning, not the 0, that goes on to the balance sheet. So the statement of retained earnings, the way that net income and the distribution of dividends affected the financial position of the company during the period. Notice that this statement also begins with the name of the company, followed by the name of the statement, then either the time period or period of time. The statement of retained earnings is also a period of time, just like the income statement. The third statement is the balance sheet. The balance sheet's purpose is to report the amount of a business's assets, liabilities, and stockholders' equity at a specific point in time instead of a period of time. The first formula we learned, assets, liabilities, and stockholders' equity, do you remember the name of the formula that had those in it? The basic accounting equation. The first formula we learned, assets, liabilities, and stockholders' equity, do you remember the name of the formula that had those in it? The basic accounting equation. Now notice on the balance sheet that assets come first. How are assets listed? They're listed in the order of liquidity. That is, how quickly they are used up or converted to cash. They're not listed biggest to smallest like expenses or alphabetically. Next is the liabilities. They're listed in the order of how soon each is to be paid or settled. Finally, stockholders' equity is listed. It doesn't matter if you list common stock or retained earnings first. But remember, you use the ending retained earnings from the statement of retained earnings, the 1,000, not the 0. Notice that a balance sheet starts with the name of the company, followed by the name of the statement, and then a balance sheet is for a specific date or a point in time. The balance sheet balances because the resources or the assets equal the claims on those resources, the liabilities, and the stockholders' equity. The balance sheet is also known as a statement of financial position. The last statement is the cash flow statement. It shows where we get and spend cash from those three activities that all companies engage in. Remember our operating, investing, and financing activities? Remember that those operating activities are directly related to running the business to earn a profit. They include cash received from selling games and services, cash paid for employee wages, buying advertising, renting a building, obtaining insurance coverage, and so on. Investing activities involve buying and selling productive resources with long lives, such as buildings, land, equipment, and software. And financing activities include any borrowings from banks, repaying those bank loans, receiving cash from stockholders for company stock, and paying dividends to stockholders. A cash flow statement also starts with the name of the company, followed by the name of the statement, and this statement is for a period of time. In addition to the four basic financial statements, there are also notes to the financial statements. Notes help financial statement users understand the amounts, where they're derived from, and other information that may affect their decisions. We'll talk more about notes in later chapters. So, what is the relationship among the statements? Let's review. First, the income statement reports the results of the business operations for the accounting period. The net income from the income statement is a component in the determining of the ending retained earnings on the statement of retained earnings. The ending retained earnings balance from the retained earnings statement is what is used on the balance sheet, not the beginning. If we did not report the ending retained earnings balance on the balance sheet, our balance sheet would not balance. So the statement of retained earnings must be prepared before the balance sheet may be completed. The cash on the balance sheet is equal to the ending cash reported on the statement of cash flow. Now, let's practice preparing a statement of retained earnings. Stone Culture Corporation was organized on January 1st, 2023. For its first 2 years of operations, it reported the following. Net income for 2023 was $40,000. Net income for 2024 was $45,000. Dividends for 23, $15,000. Dividends for 2024, $20,000. Total assets at the end of of 2023, 125, and total assets at the end of 2024, 242,000. On the basis of the data given, let's prepare a statement of retained earnings for both 2023 for the first year of its operations and for 2024. So how we'll start is with what's on a statement of retained earnings. Okay, we're going to start with the name of the company, and that is going to be the Stone Culture Corporation. After the name of the company is the name of the statement, and that is the statement of retained earnings. And then next, it's either a time period or a period of time, and a statement of retained earnings is a period of time, and this is going to be for the year ended 12/31/2023. Now remember, a statement of retained earnings has 4 lines, beginning retained earnings. So we'll go with January 1st, 2023. This is a brand new company, so it starts with $0. We add net income. Now remember where we get net income from? Income statement. That's that first statement that we do. And our net income for 2023 was $40,000. Then we subtract dividends. Then we subtract dividends, and dividends for 2023 was $15,000. And that gives us our ending retained earnings on December 31st, 2023 gives us 25,000. 40,000 minus 15 is 25. And there we go. That's going to be for our first year. It asked us to do it for 2 years, so we're going to repeat exactly what we had right there. We're going to start with the name of the company. We're going to do the statement of retained earnings for year ended. Again, I'm abbreviating. This is 12/31/2024. Now, our beginning retained earnings is going to be last year's ending retained earnings. So we're going to have 1/1/2024 retained earnings is going to be 25,000. We're going to add the net income. And again, our net income comes income statement, the first statement that we do, and that is going to be 45,000. Plus 45 is 70. 70 minus 20 is 50. And then I will show you the pretty version so that you can read the writing. Next, we're going to be preparing a balance sheet. Designer Brands Inc., previously called DSW, which was Designer Shoe Warehouse. They sell fashionable shoes.
Check, check. All right, like I was saying, balance sheet has assets, liabilities, stockholders' equity. So before she gets started, I'm gonna title these. Number one. My scratch paper right here. Number 1. So we got assets. No, number 1, amounts owed to suppliers. That's a liability. Designer brands right to collect on it. That's an asset. You give me my money. Just give me my money. Currency and bank accounts balances. That means you got a liability right there. You got to pay that. Common stock issued. That's stockholders' equity. SE. Warehouse stores. That's an asset. That's what we own. Merchandise held for sale. It's an asset because it's held for sale. We still have it. Amounts owed for promissory notes is a notes payable, liability, and accumulated profits asset.
Choose. The balance sheet, which is February 1st, 2020, contained the following items. Amounts owed to suppliers, 680, and these numbers are in millions. So whenever you see millions, that means there are 6 zeros added, so that's 680 million. Designer brands right to collect on an account, that's 89 million. Currency and bank account balances, 111 million. Common stock issued to shareholders, 456 million. Warehouse stores and offices, 1,632 million. Merchandise held for sale, 633 million. Amounts owed for promissory notes, 1,064 million. And accumulated profits of the company, 265 million. The first thing we have to do is give an account name commonly used for each item listed. Then we're going to prepare the balance sheet as of February 1st, 2020, and give the appropriate totals and subtotals. Then for February 1st, we're going to determine whether the financing for the assets came from creditors or stockholders. So first we're going to do the amounts owed to suppliers. What would a account name be for amounts owed to suppliers? Amounts owed would be a liability. To suppliers would be an account, so that would be an account payable. Designer brands right to collect on an account. So it has the word account. So it's either an account payable or receivable. And if it's our right to collect, that would be an example of an account receivable. Currency and bank account balances, that would be cash. That's an asset. Common stock issued to stockholders, that would be common stock. Warehouse stores and offices,
Asset, account name, equipment.
that would be buildings. Merchandise held for resale or for sale, that would
Asset,
be inventory.
inventory.
Amounts owed for promissory notes, that
Liability,
would be
notes payable.
That's a liability. And
I think of
accumulated
assets.
profits of the company, that would
Retained earnings. I got that wrong. I looked at that as an asset. The accumulated profits. I guess it's in the long run, the end run, not like sales revenue.
be retained earnings. So now that we've identified all of these, we're ready to put them in the balance sheet. So how company, we're in do the, then for February,
I'm gonna do them over. The way I'm titling them is looking at it like, where would I put it on the balance sheet? Liabilities, assets, stockholders' equity. I need the account name so I know where to put it under these things. First, we got amounts owed to supplier. It's a type of liability. Account payable. Somebody singing. Next, we got designer brand's right to collect on account. Some type of asset, bringing it in. That's an account. Receive. The third one, current. Currency and bank accounts balances. It's type of liability, which is going to the bank. We're gonna say notes payable. Next, we have a common stock issued to stockholders, stockholder equity, which would be a common stock issued to stockholders. Common stock. Warehouses, stores, and offices. It's type of asset. Buildings, though. That's an equipment. Before. Merchandise held for sale. Inventory. Type of asset. Amounts owed for promissory notes. We know it's a note. We owe it. Notes payable. Last, accumulated profits. Type of stockholders' equity. But it is retained earnings.
First, we're going to determine whether the financing for the assets came from creditors or stockholders. So first, we're going to do the amounts owed to suppliers. What would a account name be for amounts owed to suppliers?
Accounts payable.
Owed would be a liability. To suppliers would be an account, so that would be an account payable. Designer Brand's right to collect on an account. So it has the word account.
Account receivable.
So it's either an account payable or receivable. And if it's our right to collect, that would be an example of an account receivable. Currency and bank account balances.
Note
that would
payable.
be cash, that's an asset. Common stock issued to.
Hold up. Currency and bank account balances. Is that what it said? Currency and bank account balances. So I'm reading that shit as balance due. But it don't say anything due. It don't say owed. So currency is a cash. So I got that wrong. Twice. It's not a liability, it's an asset of cash. That means we can go to the bank and get that right now. Common stock is next. Stockholders' equity is a common stock.
Amounts owed to suppliers. Amounts owed would be a liability. To suppliers would be an account, so that would be an account payable. Designer Brand's right to collect on an account. So it has the word account, so it's either an account payable or receivable. And if it's our right to collect, that would be an example of an account receivable. Currency and bank account balances, that would be cash, that's an asset. Common stock issued to stockholders.
Stockholder equity, common stock.
Common stock. Warehouse, stores, and offices.
Asset building.
Buildings. Merchandise held for resale or for sale. That would be inventory.
An asset of
Amounts
inventory.
owed for promissory notes.
Liability.
That would be
Notes payable.
note payable. That's a liability.
Next is a stockholder's equity.
Accumulated
Retained
profits of the
earnings.
company. That would be retained earnings. So now that we've identified all of these, we're ready to put them in the balance sheet. So how does our balance sheet start? Starts like any other statement. Okay, so we start with the name of the company, Designer Brands Inc., followed by the name of the statement. This is the balance sheet. Then this is going to be for a specific date. Now remember, the income statement, statement of retained earnings, and cash flow statements are all for periods of time, and the balance sheet is for a point in time. This one is February 1st. And we're going to go ahead and add that these numbers are in millions. Balance sheets start with assets. Now, do you remember how assets are listed? In the order of liquidity. The order of liquidity is the most easily converted to cash. Now, we identified 4 assets. We identified accounts receivable, cash, buildings, and inventory. Of those 4, which is the most easily converted to cash?
Cash.
Hopefully you're thinking, well, that would be cash. And that would be correct. We had cash at $111 million.
Accounts receivable.
Next, we would have
Inventory,
split
building.
between accounts receivable, buildings, and inventory. If you're not sure what an account receivable is, that's when our customer purchased something and says they're going to pay us later. And I'm going to abbreviate accounts receivable with AR. And an account receivable will be our most next liquid, the most easily converted to cash. They're going to pay us within 30 days. Next, we have a choice between buildings and inventory. Which do you think would be most easily converted to cash? What we sell in our business or our building? Yep, inventory. And that's 633. That means our final one is building. And that is 1632. And that is going to be a total of $2,465,000,000. Now, don't forget in your homework, in Connect, one of the most commonly missed things, and you'll get a correct but not complete, is the word total assets. Another most commonly missed is the date. So if you hit the check my work and you get a correct but not complete, you might be missing the name of the statement, the date, or one of the totals. The next area after assets would be liabilities. I'm going to move this up and do our next area. What were the names of the liabilities that we identified?
All right, we got two actually. And we one of the biggest, smallest. I don't know the order of the numbers, but excuse me. We have accounts payable and notes payable. We're most like, it don't matter the amount, it matters which ones do first. Accounts payable, then notes payable. We got to pay our suppliers. We got to pay our bank loan. But the bank loan might be 10 years or net paid, whatever. The accounts like Office Max and all that stuff is due first.
But there's people here, so I'm gonna start taking pictures next. Just doing, what are you most on? TikTok or? Social media I don't do consecutively, but
bro,
trying to bring the YouTube back.
It's so hard to stay active on social media, man. It's like I got the client work, and then I'm trying to like post stuff for myself too, because the stuff that I post on Instagram doesn't always need to be client work.
You do your own editing,
Yeah,
so that's a lot of work.
yeah.
Why not hire somebody?
I mean, I can do it, but yeah.
That's what I was thinking about doing. Just give them a certain amount of content, let them do their thing.
I have hired an editor to shoot for a circuit before.
Yeah.
I mean, edit content that I shot.
Right.
There's some good editors out there, real good. So
I mean, that will save you time.
Yeah.
I don't know what you like more, shooting or editing.
you know,
You do both pretty good though.
thank you. No, I mean, I like both. It's weird. Like, I don't really know what I like more. Cause
That's why I don't get stuff out,
a
man.
lot of the guys that I know, they don't like editing, but I like both. So it's like, it's hard to. I have to give up the creative control though.
You do.
Otherwise, I can't be as fast, you know.
That's
So
what I'm saying.
yeah. All right, bro. Hey, have a good night.
Level up, bro. Switch out to camera. That's how much. You want to say hi? Cheers. I see a UNLV beer over there.
We're not pros, just bros. Beer bros. Beer!
What's up, bros? This is Soup.tv. We about to go hit that beer fest up. You ready? Let's go.
Identified 2 accounts and notes. We're going to go with accounts first because we pay them off before our notes.
Accounts
If you don't
payable,
remember,
notes
there
payable.
were 3 differences between our accounts and our notes payable. An account is shorter than a note, 30 to 60 days, where a note might be 60 to 30 years. Notes are going to have interest. Notes are more formal. I think bank when I think note. I think supplier when I think account. Account, we got 680. We got 1,064,000,000. We got our total liabilities, and that is 1,744,000. Then we're going to list our stockholders' equity. There are 2 accounts in stock.
Yeah, the 2 we have are going to be common stock and retained earnings. I believe, I'm not sure, beginning retained earnings? Because it said accumulated profits or something like that.
Stockholders' equity, do you remember what they are? Doesn't matter what order we put them in. Connect will take them either way. Common stock and retained earnings. We identified our common stock to be 456. Now in this problem, they gave us our retained earnings at 265. Normally we would get that from our statement of retained earnings. We'd use the ending retained earnings, not the beginning. And that would be our total stockholders' equity. Then we're going to have our total liabilities and stockholders' equity. I'm going to abbreviate there. So we're going to add the 1,744,000,000 to the 721 million, and we're going to get a total of 2,465. Now remember the basic accounting equation. Assets should equal liabilities plus stockholders' equity. So do our assets equal liabilities plus stockholders' equity? Yep, we're in balance. So part 3 said, where do we finance our assets from? Is it more from liabilities or from equity? So basically what it's asking is which number is bigger, the liability number or the equity number? Looks like our liability is number, so we're doing more debt financing than we are equity financing. When we use more debt, that would be debt financing. When we use equity, that is equity financing. I'll show you the balance sheet in the pretty computer way so you can read the writing, and here's what it looks like. Now we're going to fill in the missing amounts. We have columns for total revenue, total expenses, and net.
All right. So to keep it simple, revenues, expenses, net income go together. Assets, liabilities, and stockholders' equity go together. For A, to get net income, we're gonna subtract 68,000 from 90,000. For stockholders' equity, we're gonna subtract 55,000 from 125,000. Excuse me. For B, to get revenues, we're gonna add 25,000 to 50,005. To get liabilities, we're going to subtract 72 from 105.4. For C, we're going to get a negative. We're going to subtract total expenses from revenue. We're going to get a negative 13,000. It's going to be in the bars. To get stockholders' equity, we'll subtract liabilities from assets. For D, to get expenses, we're going to subtract 22.5 from 150. Yes, positive. For total assets, we're going to just add 160 and 90 together. For E, to get revenues, we have to add 16,000. No, it's negative. Subtract 16,000 from 93,000. And then for total assets, we need to add liabilities and stockholders' equity. So I have 45 and 48. That should be 93.
Net income, total assets, total liabilities, and stockholders' equity. Do we know any formulas involving these accounts? Revenue minus expenses gives us net income, and the basic accounting equation, which is assets are equal to liabilities minus stockholders' equity. Using these equations, let's solve for the missing amounts in each case. In case A, the amount of net income or loss is missing. We know that revenues are 90,000 and total expenses are 68. By deducting total expenses from total revenues, net income would be 22,000. On the balance sheet, total assets equal 125,000 and total liabilities equal 55,000.
Subtract
According to the
55.
balance sheet equation, total
Assets plus equal total liabilities plus stockholders' equity. By deducting total liabilities of 55,000 from total assets of 125, we determine that stockholders' equity would be 70,000. In case B, we need to find the amount of total revenues reported. Total expenses are 50,500 and net income is 25,000. So what would total revenues be?
Did you get 75,500? On the balance sheet, we need to find the amount of total liabilities. Total assets and total stockholders' equity are 105,400 and 72,000. How would we calculate total liabilities? Did you deduct total stockholders' equity from total assets to get 33,400? In case C, net loss is missing. We know that total revenue is 60,000 and total expenses is 73,000.
Negative
How do we
13,000.
determine the net income or loss? Did you deduct total expenses from total revenues and calculate a net loss of 13,000? On the balance sheet, total assets equals 89,000 and total liabilities equal 35,000.
What's that, 50?
How do we calculate stockholders' equity?
54,000?
Did you deduct total liabilities of 35,000 from total assets of 89,000 and get 54,000? Case D, total revenues are 150 and net income is 22,000.
Subtract them, get a big number.
Go ahead and calculate total expenses. Did you deduct net income from 22,500 from total revenues of 150,000 and get 127,000?
Yes, I did.
On the balance sheet, total liabilities equal 90,000.
Just add those together.
Equity equals 160,000.
It's going to be 270. No, 250, sorry.
Did you get 250,000? In case E, you need to find the amount of total revenues.
It's going to be
expenses are
less than 93.
And there is a net loss of 16,000. If there's a net loss, will expenses be more or less than revenue? Expenses will be greater than revenue. You should deduct the net loss of 16,000 from the 93,000 in expenses and calculate the total revenue to be 77,000. On the balance sheet, total liabilities equal 45,000 and stockholders' equity equals 48,000. You need to calculate total assets. The sum of liabilities and stockholders' equity is 93,000. Hi, this is Tammy Perry with Accounting 201. We're with Objective 1.3, explaining how financial statements are used by decision makers. Here is how creditors and investors use financial statements. Creditors are mainly interested in assessing two things. One, is the company generating enough cash to pay what it owes? Which of the four basic financial statements, the income statement, statement of retained earnings, balance sheet, or cash flow statement, would we find out if a company was generating cash to pay for what it owes? You may be thinking that cash is an asset and assets are on the balance sheet,
Income statement.
but that shows how much cash we have. And this is asking, are we generating enough cash? Remember, we get cash from stockholders, from a bank, or from sales. To pay back a loan, we want to look at what activities we are engaging in to see if we are generating cash. Which statement shows operating, investing, and financing activities?
Statement of cash flows.
Are you thinking statement of cash flows? Creditors would find this information on the statement of cash flows. The second question creditors may ask, does the company have enough assets to cover its liabilities? Which statement has assets and liabilities on it?
Balance sheet.
Are you thinking balance sheet? Creditors would find this information on the balance sheet by comparing assets and liabilities reported. Now, investors expect a return on their contributions to a company. This return may be immediate through a dividend. Which statement has dividends on it?
That's the
you
balance
have a choice
sheet.
between the income statement,
No.
statement of retained earnings, balance sheet, or the cash flow statement. Did you say
Return.
statement of retained earnings?
Return earnings.
That's correct.
Retained earnings.
This return may be also long-term through selling of a stock certificate at a price higher than its original cost. Dividends and higher stock prices are likely to be if a company is more profitable. Which statement shows profitability? Did you say income statement? As a result, investors look closely at the income statement and statement of retained earnings for the information about the company's ability to generate profits and distribute dividends.
All right, fuck what you heard him say. I've been up since early this morning handling business. I'm about to write down this information on my sample sheets. Income statement shows profitability. That type thing. And then I'm about to go take a nap. Then I'm gonna wake up, chill with my kids. They want to play Minecraft tonight. We have a survival level, Survivor 100 days. We're gonna do that. And then I'm gonna get back to homework. I'm gonna finish these slides. I've already done chapter 1's homework. I'm just going over the slides again. Then I gotta study Spanish. I gotta do all these flashcards. And I have 2 book readings to do. Accounting, chapter 2, Spanish. And then tomorrow I gotta go pick up my communications book because we got some reading assignments in that I can't do without the code. So I'm about to go take a motherfucking nap. I just ate lunch, got shit accomplished. It's that time, so I'm gonna catch y'all later. Make sure you look for another stream. I have no schedule yet. We getting to it though. I'll probably play video games next. Y'all see that? Me and my kids play Minecraft. We're gonna stream that here on YouTube. So make sure y'all check me out. Got YouTube. Here's my channel name, The Vegas Suit. Come check me out. All right, y'all. I holla. Peace.